Hey guys, so with Ian boots on the ground right now at the Ethereum conference, literally finding 100x projects as we speak. He is out today, so we're not going to be doing a Menti code or an AMA, but I will be doing my segment just in a moment before we do actually sign off without an AMA or anything like that. But with the Ethereum birthday coming up, we are running a special for non-customers. So if you're not a customer, right, you can go to the Token Metrics website, tokenmetrics.com, and you can scroll down to subscribe to TM Weekly. This is our free newsletter, right, our mailing list, and just put in your name and your email. And we're doing an Ethereum birthday package where you're going to get an Ethereum tech or code review, an Ethereum investment report, so like a fundamental analysis, Ethereum TA report from Bill, as well as an Ethereum TMTV video, right? So it's going to be a really good example of the value that we provide with other cryptocurrencies in honor of Ethereum's birthday. So head over to tokenmetrics.com and sign up for the free newsletter if you're not a customer. If you are a customer, you should be getting that email regardless, as well as our other newsletters throughout the week. Now, my segment contains a little bit of math, right? But it's very easy math, and I know we can get through it. We get the question all the time, and I know I get the question all the time of what allocation of stable coins should I have in my portfolio? How much should I have in stable coins right now? And I'm going to walk you through an example of why I think actually striving to keep a constant allocation of stable coins is better than a variable allocation of stable coins, right? And what I mean by this, what I mean by a constant rate of stable coins or a constant allocation of stable coins is trying to rebalance towards, let's say, for example, 10% in stable coins at all times. And by at all times, I don't mean like every single day reallocating. That wouldn't be very feasible. And you get eaten up with fees. But after big moves, after the crypto market makes a big move, and we're just looking at the Bitcoin chart here as a backdrop, reallocating to 10% stablecoins. Now, I'm just throwing out 10% out there, and that's not financial advice. 10% is just what I use because I'm actually pretty bullish on crypto long term for many reasons, including if we cut over to the total cryptocurrency market cap chart, we're seeing exponential growth over time. So I want a lot of exposure. Now, if you have a lower risk profile, maybe you're older, you just aren't as bullish as I am on crypto, maybe a 20% allocation works. And 10%, 20%, that might seem like a small allocation, but I'm going to show you why it's actually a pretty large allocation, right? And before I jump into it, I'm also just going to pull up here our token metrics indexes or indices, and you're going to often see, like if I go to the yearly, right, the yearly investor large cap portfolio, our AI is allocating roughly 14% to Tether. So like roughly 14% to stable coins is what our AI is telling us to do. So somewhere in that, maybe if you're very aggressive, 5% to 20, 25% on the low end is probably a good allocation to strive for. But I'm going to give examples as to why I think a constant allocation beats constantly trying to change your allocation, right? Up here being in like 50% and then trying to be at like 5% down here. It just overcomplicates things. And by actually keeping a constant allocation of, let's say, 10%, it forces you to buy the dips and it forces you to take profits. The two hardest things. It takes the emotion out of it, right? So let's get into it. Let's say up here, right? For example, before the dip, you kept a 10% allocation to stablecoins, right? Let's say you had $100,000, 90,000 of that was in crypto, right? And I know we're looking at the Bitcoin chart, but we're just using this as a backdrop for the direction of the market. And then the other 10% or the other $10,000 of your $100,000 was in stablecoins. Well, then we got a 55% drop. And it just so happens that this works out pretty decently with the math. But that drops your portfolio a little bit or roughly in half, right? You went from $100,000 to $50,000. You would have dropped more if everything was in crypto, but because you were in stable coins, your actual total portfolio, despite a 55% drop in crypto, only dropped by 50%. Now, what's our allocation in stable coins? We haven't touched anything yet. We haven't made any trades. We've got $50,000 total, 40K in crypto, 10K in stablecoins. That's a 20% allocation to stablecoins, and we haven't even touched anything. So because our target, right, because our target's 10%, after this huge move, we have to rebalance. Well, how are we going to rebalance this to get to our target of 10%? Well, we're going to have to buy the dip, right? We're taking some of our stablecoins, some of our 10,000 in stablecoins, and we're selling those stablecoins to buy crypto, right? So now we have 45K in crypto. We're back to our 90-10 ratio. And of course, right, these, the individual cryptocurrencies in your portfolio are going to differ, right? But just saying, in totality, 90% crypto, 10% stablecoins. And the beautiful thing is our AI does this most of the time. This is something I've noticed. Like right now, it's giving a 14% allocation in Tether, right? So now this keeping a constant stablecoin allocation has forced us to buy this dip. Now, the question you may have is, well, what if we dip lower? What if we see a flash crash? Well, if we see a flash crash, right? If we dip lower, we're going to see our crypto go lower, but our stable coins at 5K are going to stay the same. They're going to stay the same, right? So our allocation, this 10%, is going to get off balanced again. It's going to go up to 15 or 20%. So then we can take, 2,500 or whatever we have left over to get back down to this 10% ratio. So we're always rebalancing to get to a 10% ratio, and it's forcing us to buy the dip with part of our stablecoin allocation. Now, I don't recommend it for everybody, but if you understand leverage, you can actually lever up, right, to 2x or 3x, right? If you use 2x or 3x leverage, this 10% allocation is actually giving you a 20% or a 30% buying power in terms of stablecoin allocation. Now, I know this is a complicated concept, and a lot of people don't understand leverage trading. I don't recommend you do it. This is not financial advice unless you understand it. But that is the power of 10% in stablecoins, because we can always lever up to 20 or 30% if we dip, and all of a sudden now we have a huge chunk of our portfolio in liquid stablecoins or levered up to buy the dip with. Now, let's just say the market recovers. We see a 5x, right? We're expecting over the long term, of course we could dip lower, but we're expecting over the long term that we're going to maintain this extremely fast growth, right? The total cryptocurrency market cap right now is $1.4 trillion. That's laughable compared to where we're very likely headed, in my opinion, right? So let's just say your portfolio 5x's, you value invest, you're a Token Metrics customer, you get these code review scores, and your portfolio does a 5x. Well, because you bought the dip, you actually made more money in terms of crypto. So instead of, had you not changed anything and rebalanced, you would have gone from 50K, right, to, done the math here, they're wrong. This should be a 4x. Let's just use 4x. Right? So a 4x would take you to 200K, but because you rebalanced, you actually now have 230K, but your stable coin allocation is off again. Now it's dropped below 10%. So what's that forcing us to do? To get back to a 10% allocation instead of this 2%, it's forcing us to take profits, something that people have a huge issue doing. It's one of them. It's honestly more difficult than buying the dip. Buying the dip can be easy if you believe in crypto long term. But when everything's going up, right? When everything's going well, actually rebalancing and taking profits and moving into a 10% stablecoin allocation is difficult to do. But if we just keep this target of 10% stablecoins, right? And we move over, it forces us to take profits back into, right? We have a total of 230K. So 23,000 in stablecoins, 207 in crypto, and we have an extra $30,000. We have an extra 30K after this 5x move because our allocation, our constant allocation to stablecoins forced us to buy the dip, right? We have an extra 30K than if we'd have just seen a 4X on our 50K, right? All right. So I hope this made sense. That's why I believe a 10% or so stablecoin allocation or rather a constant stablecoin allocation is advantageous. It keeps things simple. It forces you to buy the dips. It forces you to take profits.
Token Metrics is a cryptocurrency investment platform that helps users leverage machine learning to become better crypto investors. Our in-depth analysis helps eliminate the emotions of investing, find profitable investment opportunities, and filters out scams. Learn more at tokenmetrics.com.